A lot of people have been saying that the S&P 500 looks like the dot-com bubble. Same concentration, same valuation, but here is what they are not telling you. The dot-com bubble was a bet on a technology that about 95% of the world had never ever used. The companies building it had no revenue, no profit, and frankly, no realistic path to either. They were building the infrastructure first and hoping that the world would catch up. Some of them were right about the technology, but almost all of them were wrong about the valuation. And today, people were using that story to scare you out of the best run and most profitable companies in the history of the stock market. Let's go back to the year 2000. The internet was genuinely revolutionary. Everybody could see that, and so money flooded in. But at the peak of the bubble, only 6% of the world's population was online. That's approximately 400 million people out of 6 billion. Companies were building fiber networks, server farms, and global infrastructure for technology that most of humanity had never touched. The technology was real, the timing was catastrophically early, and the valuations were completely disconnected from any business reality. Here are the actual numbers. 86% of the Nasdaq tech IPOs, that's initial public offering, at the peak were unprofitable. Cisco reached a price-to-sales ratio of 200. 74% of the internet companies had negative cash flow. Amazon had roughly 10 months of cash left and no clear path to profitability. The Nasdaq 100 forward price-to-earnings did hit 60 times at the peak, and tech was about 33% of the S&P's market cap. But it was generating just 15% of the index's earnings. So the entire sector was borrowing the index's valuation without actually earning it. So why are people drawing the same comparison today? Because on the surface it does look similar, surely. Tech and communication services combined are now roughly 50% of the S&P 500. The Shiller-Cape ratio, which basically smooths earning over 10 years, is currently around 41, not far from the dot-com peak of 44. The S&P 500 forward price to earnings is about 21, and the top 10 stocks account for roughly 40% of the entire index. So the concentration is real, there is no getting away from it. And they're not wrong to flag it. The comparison is real, but it is also deeply and fundamentally incomplete. In the year 2000, tech was 33% of the S&P 500's market cap, but only 15% of its earnings. Today, it is the exact opposite. Tech drove the majority of the S&P 500 earnings growth last year. Not the majority of the hype, the majority of actual reported profits. The S&P 500's net profit margin hit 13.4% in Q1 of this year. That is the highest that has ever been recorded, going back to about 2009 when FactSet began tracking it. And analysts expect that it will keep climbing, with profit margins projected at 14.1% and 14.6% throughout the rest of 2026. The information technology sector specifically is running a net profit margin of about 29%, which is up from 25% a year ago. NVIDIA has a gross profit margin of 74% and a return on invested capital of 104%. That means that for every single dollar invested in the business, it generates $1.04 back. Microsoft generates more free cash flow annually than the GDP of many countries. Apple has bought back over 700 billion of its own stock because it has so much cash that it doesn't know what to do with it. These are not pets.com. These are the most profitable enterprises in human history. Now, let's talk about those valuations that everybody keeps citing. The Nasdaq 100 forward price to earnings peaked at 60 in the year 2000. Today, the S&P forward price to earnings is about 21, and the tech sector specifically trades at roughly 35 times forward price to earnings versus 50 or more at the dot-com peak. Yes, 21 is obviously elevated versus the long-term historical average of about 15 or 16, but that average includes decades when interest rates were much higher profit margins were much lower, and the index wasn't full of software and semiconductor companies with 70 to 80% gross profit margins. Full year 2026 S&P earnings are projected to grow more than 20%, with quarterly estimates running in the low 20s. That's percentage as well. This is not an index priced for perfection with no growth behind it. This is an index where the underlying businesses basically are growing earnings at about 20% per annum. But here is where it gets interesting, because there is one genuine parallel between then and now, and the bears are actually right about it. Only about 19% of US companies have actually deployed AI so far. But the capex being spent on AI infrastructure is absolutely enormous, hundreds of billions annually. And if that spending doesn't translate into broad productivity gains, then multiples will compress. That's a real risk, I am not dismissing it. But here is the critical difference. In the year 2000, the companies building the internet had no revenue while they waited for the adoption. Today, NVIDIA and Microsoft, Meta and so on and so forth are generating hundreds upon hundreds of billions in annual revenue, and they are growing at about 60% per year. Right now, that is before mass AI adoption. The infrastructure builders are already enormously profitable before the technology even reaches scale. In 2000, you were paying 200 times sales for a promise. Today, you are paying around 24 times earnings for a business that is already printing money. So what is the risk here then? Because there is one. And that is the S&P 500 has only been this expensive a small fraction of the time in its history. Elevated valuations are strongly correlated with lower returns over the next 5 to 10 years. That is real. But lower future returns and a bubble crash are completely different things. One thing means that your index might return 6% annually instead of 10% over the next decade. And the other means, well, an 80% drawdown and 17 years to recover basically. And the data today supports the first scenario, but it definitely does not support the second. And in my opinion, even in the first scenario, it still beats a crash. The dot-com bubble was a valuation without a foundation. Companies with no real revenue, no profit and no customers, valued at hundreds of billions because the technology was real, even though the businesses were not. Today, the S&P 500 is expensive because the companies inside it are actually exceptional. Record margins, record earning growth, real cash flows, and the technology tailwind that is still in its early innings. So, it is the same concentration, same scary headlines that we are seeing, but completely different reality underneath. The bubble comparison is not wrong because valuations are low. They are not. But it is wrong because this time the earnings are real.